Good afternoon, friends. As a part of this Gyanshorts video series, today we are going to be talking upon the Indian Insurance Accounting Standard. This Indian Insurance Accounting Standard is IFRS 17 or Ind AS 117. This standard today is going to change the fundamental manner in which insurance companies account for the premiums, for the revenues, for the claims, for the all kinds of income and expenses that an insurance company accounts for. The need for a industry-specific accounting standard was felt way back in 1997, considering the complexities of the insurance industry. To the best of my knowledge, there is no accounting standard that is specific to an industry except probably construction contracts. So this is probably the second one that comes in line to say that an industry-specific accounting standard released by the IASB has now come into force. So IASB started work on this in 1997, right? And it got notified globally maybe 3 or 4 years back. Implementation started globally 3 or 4 years back. But that itself shows the complexity, the challenges that insurers are going to face when accounting or when implementing for this standard. And as an interim standard, IASB came out with Ind AS IFRS 4 or Ind AS 104. And based on that, people were accounting for insurance contracts. Ind AS 104 as a standard never really prescribed any recognition or measurement criteria. It only prescribed the definition of what would constitute an insurance contract and subsequently what would constitute what are the disclosures that would require. But the recognition measurement principles in Ind AS 104 or IFRS 4 was silent. Today in India, IFRS 17 is known as Ind AS 117. Ind AS 117 basically is notified by the MCA, which states that the standard is implemented, but the implementation date is left to the regulator, which is IRDAI. So IRDAI is yet to notify the date on which IFRS 17 will become applicable to insurance companies. So that is the status. Yes, there are certain companies that could fall into the definition of an insurance contract who are non-insurance companies. IFRS 17 would be applicable to them. But today in India, we have not seen any practical implementation of this particular standard. So keeping that in mind, let's give you a little bit of a background on this IFRS accounting standard. So as usual, every accounting standard has its own exclusions, and so does IFRS 17 have. But the key point for this video that is relevant is to understand that financial guarantee contracts are an exclusion to this standard. Now, financial guarantee contracts form under Ind AS 109 and they can be treated as a form of insurance as well. So there is also a discussion that is going on as to what is a financial guarantee contract. When a company, when X corporate gives a financial guarantee to a Y corporate, simple, it's a financial guarantee on the performance of a Y company. Is it a financial guarantee or is it a performance guarantee? So if it is a performance guarantee, if one meets the definition of a performance guarantee, then that amount would be that transaction would be treated as an Ind AS 117 transaction and instead of Ind AS 109 transaction. That is an ongoing debate which is yet to be completely settled. Coming to the standard on IFRS 17, IFRS 17 primarily has prescribed the measurement criteria. Hitherto, premium income was being recognized as and when received by insurance companies. IFRS 17 basically tells you that you need to estimate your future cash flows of each portfolio of contracts. So one, you need to identify a portfolio of contracts, aggregate those or aggregate various contracts into one portfolio. Take the present value of the future cash flows. So the future cash flows will be all the inflows arising on that group of contracts. Could be premium, could be renewal premiums, could be other top-ups, whatever, as a part of the inflows of the contract. And the second part would be all the expenses related to the contract. Could be acquisition cost, could be your claims payment, could be administrative cost, could be policy servicing cost. You need to take all those costs, arrive at your net present value of the cash flows, discount that with to the present value, apply a risk adjustment rate to your value, and that will give you your net contractual service margin, which means that this is going to be your net margin on this portfolio of contracts, and that net margin is recognized as and when over the contract period as revenue. So this is the key difference in IFRS 17, in which the top line of insurance companies will change, the revenue expense pattern will also change, and so will the net worth position, and the net worth reserves will also change. Indian companies have started implementing IFRS 17. IRDA has prescribed a pro forma format in which Indian companies need to apply IFRS 17, and therefore some companies have started applying IFRS 17 in a phased manner in India. This is the status of implementation in India today. This is the key method that I spoke about contractual service margin. For other contracts which are not long-term contracts, the standard gives you an option to simply take a simplified approach. There are contracts within a duration of 12 months where you simply take a simplified approach. In our good old days, if you call it the prepaid or the reverse of prepaid unexpired premium reserve, you simply amortize that over a time basis. So this is the key difference again between the two options that are available in the IFRS 17. Another key impact here of IFRS 17 is that investment income on the portfolio that insurance companies earn is totally separated and shown distinctly on the profit and loss account. So the profit and loss account and the revised IFRS 17 shows you the operating results of the insurance companies very separately and the investment operation separately. So one gets an idea whether the insurance operation is making a profit or a loss, or whether the investment is contributing to it or not. So this is the difference between the existing framework and IFRS 17 as well. In terms of transition approach, this is the biggest challenge the industry is facing today. The standard gives you approaches of doing fully retrospective, means all the portfolio, all the policy contracts that you have written till date, you go back in time, rework those contracts basis IFRS 17 and recompute your CSM. That is one option given, which is called fully retrospective. The second option given is modified retrospective, where you still do the same thing but with certain set of carve-outs, where you don't do this, you don't do that, and you don't do 3 or 4 things. And the last is the simplest approach, where you don't do any reworking, you simply take the fair value of all your insurance contracts and you go ahead and apply the fair value approach out there. So these are the transition approaches, and of course this standard has gotten significant amount of disclosures. So the disclosures probably in the standard are quite a bit, both qualitative and quantitative disclosures. So this, in a broad nutshell, is the concept of insurance contracts of IFRS 17. Today, India is awaiting a date from IRDA as to when insurance companies will be implementing IFRS 17. But in the meantime, each insurance company is submitting their pro forma financials to IRDA to submit. One of the things as accountants, we must be cognizant of that there is a lot of actuarial input involved, because the main work on computing contractual service margin, computing the present value of the future cash flows, computing your reserves, your net worth, and all of that will be based on actuarial inputs. So there's going to be a great deal of interaction with actuaries that is going to happen for us as accountants, as auditors, and that's what we need to keep in mind. We need to upscale ourselves, we need to upgrade our skills to ensure that we as accountants are able to understand and relate to actuarial aspects, because now it is not only the policy liability figure, a single figure on the balance sheet, that we are relying upon the actuarial appointed actuary of the company, but the entire balance sheet, the top line, the expense, the premium will largely flow from actuarial concepts. With this, I thank you very much for giving me the opportunity to speak on this. Thank you so much.